Previously on Stay in Your Lane.
But consumers are 70% of all economic activity. So as a policy, I think we need to think about what the effect of the tariffs, and we see potential for job loss, and we also see potential for inflation. That's the big problems with tariffs: job loss and inflation. So this is consumer inflation broken into four time periods, from the end of World War II to 73, 2.7%. And then we went in this era of very high inflation with the energy crisis and so forth. And then from the 80s through to NAFTA, and then from NAFTA to now, inflation's been 2.2%. This is the benefit of globalization, of global trade. It's why Americans have enjoyed inflation of 2.2%. And I've been able to buy a plethora of goods from Mexico and Canada, Mexico and China at very low prices. A benefit to the consumer. That's a pretty, that's a good thing about global trade. A recent survey also showed that consumers on the right here are more interested in about affording monthly expenses as opposed to producing goods here in the U.S. You can get surveys to say different things, but consumers are, they want to make sure they can get things less expensive. And I think I was just looking at some stuff about information about China. All the apparel in this country, it's something like 50% of it is made in China. And something like in Walmart, something like 70% of all goods are made in China. So if you put a tariff on there of 200%, you triple the price, that's going to be pretty significant to a lot of consumers who go to Walmart looking for inexpensive goods. So this needs to be thought through a little bit. Now, because of all this and the understanding that there could be job loss and inflation, the tariffs, even before they went into place, caused damage. I'm going to show you a survey called the ISM survey. It's been around since World War II. It's a survey of supply managers who are right on the front lines. And there's numbers, but they also give comments. And it shows that uncertainty is actually driving economic decisions now. So here's some of the comments that I've highlighted already. Tariffs, uncertainty. Customers are pausing on new orders. There we go. There we go. Just like me and my wife.
Hit the brakes.
Yep. Let's not spend right now. Uncertainty on tariffs. Harder to project how they're going to affect business. Customers buying less, looking for substitutes. Tariffs, inflation, tariffs, costs going up. Customers keep us cautious on spending. Hesitant customers still very hesitant to commit. Right there, this is where the uncertainty hit, and this was, I think this was probably from 6 weeks ago. Uncertainty is making people slow down on their spending. Businesses saying, I don't know what to do. My customers are slowing down. I don't know what the tariff thing is going to be. Should I invest? Should I not invest? This was the manufacturing side. That same comments on the services side. Same thing. So that's where you see uncertainty itself. And you see this in another survey from the Kansas City Fed. Same kind of language. The charts showing prices going up. And then there's a well-followed consumer confidence survey. It's called the University of Michigan Consumer Sentiment. This is a month old. It's now gone down 4 straight months to the second lowest level ever. And this goes back 75 years, the second lowest level in the history of this chart, 75 years. And people are expecting a worsening outlook. and a worsening financial situation in a year, and they're seeing a surge of inflationary expectations. This is what consumers think inflation is going to be a year from now. It was just updated. It's now up to something around 6%. This isn't good because expectations of inflation actually build, uh, um, contribute to inflation. So, for instance, if you're a consumer and you think inflation is going to go up, you might demand higher wages. Or if you're a business that's going to buy materials to sell, you might raise the price of that good even before you buy the material because you think it's going to be higher in price. So this is consumer behavior that is really very much the same sort of thing we've been talking about, thinking prices are going to go up. Here's another measure that has been down 4 straight months. Here's consumer income slowing. It's not negative, it's just not growing as fast. And you combine those two things. Well, back in January, we had this is consumption, the columns. Back in January, we had a real big drop in consumption. In February, it came back a little bit, but much less than expected. So, this consumer behavior again, real nervousness about what's going to happen in the future is showing up in that spending, showing up in the Wall Street Journal article, showing up in my kitchen. Now, I do want to show you some trade data because it can get very confusing because you have imports, exports. The difference between the two is they trade deficit, and you
Right.
have imports and exports between the US and other countries, and you have imports and exports of different products from different countries. So let me give you as what I think the kind of the headline numbers to know about trade. Let's see. Here is this chart on the left, this table. You can sort of bypass the calculations. But
Okay.
the point is, the US is virtually the least dependent country in the world on exports. Exports as a percentage of our GDP were 183 out of 195 towards the bottom.
Okay.
We don't rely on exports very much. This chart on the right is graphically the same thing. Every bar is a country. We're the last bar in this set of data. However, if you walk through this data, for instance, look at Mexico, 36% of their economy depends on exports. 27% depends on exports to the US alone.
Mm-hmm.
Canada, it's 21% of Canadian economy is exports to the US alone. We should treat these countries better. They're our partners. And we can look at this trade by country. And the deficit, this is the thing that the administration points out explicitly. Not so much the exports, not so much the imports, but the difference between the two. And the deficit comes from China and Mexico. Here's China is responsible for 30% of all the trade deficit, Mexico 20, and then it drops off fairly sharply, and Canada's less than 5%. So I think it's be a good idea to maybe leave Canada alone a little bit. I mean, it just shows that we're actually quite even in trade with them. And by the way, a trade deficit isn't necessarily a bad thing. It means that we buy more stuff from, let's say, Mexico than Mexico buys from us.
Correct.
We buy stuff, we exchange money for goods, right? And
Yep.
we think it's a fair trade. That's why we do it. and they buy stuff from us. It's a fair trade. Nobody's forcing either side to do anything. There's no inherent loss or gain because we're buying more or less than in other countries. The chart on the right showed what I was talking about beforehand. This is the trade deficit by month. This is in January. And this was this front running businesses, companies, and consumers buying goods and services tremendously, running up this trade deficit in January to get in front of tariffs that were coming.
Okay.
Okay, let me just review for a second. We're not dependent on exports at all. Canada and Mexico are. China and Mexico comprise most of the deficit. Here's the front running to avoid tariffs. And now let me just look at it in a little bit more detail by country. So here are U.S. exports and imports, and the size of the pies is relative. On the left, we have exports, and you can see that the biggest market for our exports are Mexico and Canada, our friends in North America. China is a relatively small slice of pie for our exports. That's why we have a bigger trade deficit with them. Mexico, in terms of imports, is a substantial portion, as is Canada here in the gray. Those two together are by far our majority of where our imports go. China's not insignificant either. Sorry, this is where our imports come from. Mexico, Canada, China. This is our exports pie over here. China, not much of a target. Now, let me show here the Chinese exports to the US, what the products actually are that we buy from China. Well, now these days, it's computer and electronic products is the biggest slice of pie. Electronic equipment, machinery, metal products, those are half of all the exports from China to the U.S. And it's actually pretty diversified, which shows you how well China has penetrated into all of our commerce.
Yep.
Look at Chinese imports now. Or I should say, U.S. exports to China. This is what we sell to China. Airplanes, Boeing, cars, agricultural products, particularly soybeans. It's a pretty diversified mix, but it's interesting what the Chinese do in their tariffs. They have targeted soybeans because that's one of the biggest markets we have is China for our soybeans.
Okay.
I'll show you that as well. So
soybeans and corn?
Soybeans, cotton, sorghum. This shows U.S. dependence on China for our exports. In other words, this shows that what this number means, sorghum, it means this 86.4% of all the sorghum we export to the world, 86% goes to China.
Yep.
So if they want to hit us, they put a big tariff on sorghum and soybeans. And guess what? That's also Trump country, is agricultural. Cotton as well, agriculture, pork, beef, as you mentioned, corn and wheat. So these are the things we're really dependent on for China to buy from us.
Continue watching on the next episode of the Stay in Your Lane podcast.